As you sit at your computer or hold your phone in your hand, I need you to do something for me right now. Close all the tabs except for this one. Yes, all of them, even your incognito tab. And I am not going to ask why you have incognito open. I'm just going to assume you are researching investment strategies that you do not want in your browser history. Yeah, sure. Let us go with that. Ladies and gentlemen, Asian guy here known as John A.G. from Currency Archive. The price you see on your screen, the price that your broker is showing you for Comic Spot Silver, is a lie. It is a fiction. It is a number generated by a computer in New York that has lost all connection to physical reality. Because while that screen tells you that silver is trading at $85 per ounce, on the other side of the world in Shanghai, China, the real price, the price that buyers are actually paying for physical metal, just hit $93. 31. Let me say that again so it sinks in. $93. 31. That is the closing price for the afternoon session on the Shanghai Futures Exchange today. Not last week, not yesterday, today, January 12th, 2026. And the spread between these two prices, the gap between the fantasy price in New York and the real price in Shanghai, is now $8. 31. $8 on a single ounce of silver. In a functioning market, that spread should not exist for more than 5 minutes. In a functioning market, every arbitrage trader on the planet would be buying silver in New York at $85, putting it on a plane, flying it to Shanghai, and selling it for $93. They would make an $8 risk-free profit on every single ounce. They would close that gap within hours. But the gap is not closing. In fact, it is widening. And the reason it is widening is the most important thing you need to understand about the silver market right now. The arbitrage is dead. The bridge between the East and the West has been blown up, and the metal that used to flow freely between the two markets is no longer flowing because there is no metal left to move. This is the day we have been warning you about for years. This is the day the paper market dies. This is the day the system breaks and you're watching it happen in real time. Let me walk you through exactly what happened today, because the numbers coming out of China are absolutely insane. The Shanghai Futures Exchange trades silver in 2 sessions. The morning session, which we call the AM session, and the afternoon session, which we call the PM session. This morning, the AM session closed at $91, 13 cents per ounce. That was already a massive number. That was already significantly higher than the US spot price, but we have seen high premiums in Shanghai before. So while it was notable, it was not shocking. But then the PM session happened and something changed. The afternoon session opened and the buying pressure was overwhelming. Not just retail buyers, not just speculators, industrial buyers, corporate procurement officers, strategic orders. They were sweeping the order book. They were buying everything available at any price. And by the time the session closed, the price had ripped to $93. 31. That is a $280 move in a single afternoon session. That is the kind of move you see in a currency crisis. That is the kind of move you see when a government loses control of its bond market. But this is not a currency. This is a physical metal. And the fact that it is moving $2 in an afternoon tells you that the buyers are desperate. Now, let's compare that to what happened in the United States today. The Comic Spot price for silver, the price that is being quoted on every financial news channel, every broker platform, every investment app, closed somewhere around $85. I say somewhere around because the price is fluctuating minute by minute. But the key point is this. The US market is trading at least $8 below the Chinese market. $8. That is not a premium. That is not a spread. That is a chasm. In the world of commodities trading, an $8 spread on a fungible asset like silver is a market failure. It means the two markets are no longer connected. It means the price discovery mechanism is broken down. It means we are no longer trading in one global silver market. We are trading in 2 separate markets that have no relationship to each other. And the most terrifying part is this, that the gap is not narrowing, it is expanding. 2 weeks ago, when we first started tracking this after the Chinese export licensing system went live on January 1st, the spread was around $5. Last week, it grew to $7. Today, it hit $8. 31. What does that tell you? It tells you that the pressure is building, not releasing. It tells you that every day that passes, the Chinese buyers are willing to pay more and more above the Western price. It tells you that they are not waiting for the prices to converge. They are front-running the inevitable breakdown of the Western market. Why are they paying $93 when the spot price is $85? Because they know that the spot price is irrelevant. The spot price is the price of a paper promise. The spot price is what you pay to buy a futures contract that might or might not deliver metal in 3 months. But the Shanghai price is the price of real physical silver bars that you can touch, metal that you can load onto a truck and drive to your factory. And in a world where the vaults are empty, where the delivery failures are piling up, the physical price is the only price that matters. So when I tell you that silver hit $93 in China today, I'm not telling you about a rally. I am telling you about a repricing. I'm telling you that the market is finally, after decades of suppression, discovering the true value of scarce physical metal in a world that desperately needs it. And this brings us to the question that everyone is asking. Why can't the arbitrage traders close the gap? Why aren't the banks buying in New York and selling in Shanghai? The answer is simple and terrifying. Because there is no silver to move. You see, arbitrage requires two things. First, you need price divergence. We have that. The spread is $8. Second, you need available supply. You need to be able to actually buy the metal in the cheap market and transport it to the expensive market. And that is where the system is breaking down. Because when the banks try to buy physical silver in New York, when they try to stand for delivery on the COMEX, when they try to source bars from the dealers, when they try to pull metal out of the vaults, they are discovering that the metal is not there. The registered inventory at the COMEX is down to around 30 million ounces. That sounds like a lot until you realize that the open interest, the total number of paper claims on silver, represents hundreds of millions of ounces. So the metal that is supposed to back all those paper claims does not exist. It has been drained. It has been taken out of the vaults by the smart money who saw this coming months ago. And even if a bank could find silver in New York, they cannot ship it to China because of the export licensing system. Once metal crosses the border into China, it is trapped. It cannot come back out. The Chinese government has effectively created a one-way valve. Silver flows in, but it does not flow out. So the arbitrage is not just difficult, it is impossible. The bridge has been destroyed, and the two markets are now floating free, completely disconnected from each other. This is the bifurcation that we have been talking about for weeks. And today is the day it became undeniable. Now you might be sitting there thinking, okay, so the Chinese are paying a premium. So what? Why does that affect me? I buy my silver in the United States. Let me explain why this matters to you. Because what is happening in China today is a preview of what is about to happen in the United States. The Chinese market is the leading indicator. It is the canary in the coal mine, and the canary just died. When the Chinese buyers are willing to pay $93 while the paper market says $85, it tells you that the paper market is mispricing the asset by $8. And eventually, the paper market has to correct. It has to catch up to reality. How does it catch up? Through a delivery, squeeze, through a default, through a force majeure declaration, through one of a dozen different mechanisms that all result in the same outcome. The paper price explodes upward to meet the physical price. And when that happens in New York, when the COMEX is forced to admit that it cannot deliver the metal that is being demanded, the US price is not going to drift up slowly from 85 to 93. It is going to gap. It is going to open at 95 or 100 overnight. Because once the illusion of the paper market is shattered, the real price is revealed. And the real price is whatever the desperate buyers are willing to pay. So the Shanghai price today is not just a foreign market anomaly. It is a prophecy. It is showing you exactly where the US price is headed, and it is giving you a very narrow window of time to prepare. But the Shanghai price is just one piece of the puzzle. Because while I was watching the Chinese market go vertical today, I was also making phone calls. I was talking to people inside the physical silver industry in the United States. And what they told me should terrify every person watching this video. I spoke to executives at major bullion dealers. These are not small mom and pop coin shops. These are the largest dealers in the country, the ones who supply the retail market, the ones who have relationships with the mints and the refineries. And they told me point blank, nobody has any silver. Those were the exact words. Nobody has any silver. The premiums, the amount you have to pay above the spot price to actually get physical metal in your hands, exploded today. Premiums that were $5 last week are now $8 to $9. And that is just the starting point for negotiation. One executive told me, and I'm quoting directly here, silver round premiums could go to $20 to $30 per ounce here. $20 to $30 on top of an $85 spot price. That would put the real cost of buying a silver round at $15 to $115. And he was not speculating. He was not exaggerating. He was looking at his inventory sheets and his order backlog and telling me what the math says. Because here is the reality. The private mints that produce silver rounds and bars for the retail market are completely overwhelmed. The orders they received in the last 2 weeks have exceeded anything they saw in the 2020 silver squeeze. And back then, they were able to ramp up production and catch up within a few months. But this time is different. This time they cannot get the raw material. The refineries are not selling to them. The refineries are prioritizing their contracts with the industrial users, the Teslas, the Apples, the solar panel manufacturers. The mints are at the back of the line, so the delays are exploding. If you order a silver round from a private mint today, you are looking at an 8-week delay. 8 weeks, 2 months. And that is assuming the mint does not run out of silver entirely and have to refund your order. Think about what that means. If you want to buy physical silver right now, you have 2 options. Option 1, buy from a dealer who has inventory and pay an insane premium. Option 2, place an order with a mint, wait 2 months, and hope they can actually fulfill it. Neither option is good, but option 2 is basically gambling. You are betting that the system holds together for 8 more weeks. You are betting that the mint can source the silver. You're betting that the price does not explode to $150 while you are waiting, making your locked-in price irrelevant because you could have just bought at the market at that point. So, if you want silver, you are going to have to pay the premium. There is no other choice. The spot price on your screen is a fantasy. The real price, the price you actually have to pay to get metal, is already pushing $100. And this brings us to a very uncomfortable truth that most investors do not want to face. The price you see on TV is not the price of silver. It is the price of a derivative of silver. It is the price of a futures contract. It is the price of an ETF share. It is the price of a paper promise. But when you try to convert that paper promise into actual metal, you discover that the conversion rate is not 1-to-1. You discover that the paper says $85, but the metal costs $100. This is the paper to physical premium, and it is exploding right now. Why is this happening? Why are the premiums so high? Because the dealers are not stupid. They know what is coming. They see the same data we see. They see the Shanghai price. They see the delivery failures. They see the comics inventory drain, and they are pricing in the future. They know that the silver in their vault today is going to be worth a lot more next month. So why would they sell it to you cheap? They are holding out for the higher price. They are rationing their inventory. They are waiting for the spot price to catch up to the physical reality. And when the spot price does catch up, when the comics finally admits that the paper market is broken, the dealers who held their inventory are going to make a fortune. They're going to sell their silver at $120 or $150. They are going to look like geniuses. But the investors who waited, who believed the spot price, who thought they could buy the dip when silver pulled back to $75, those investors are going to be left with nothing. Because by the time they try to buy, the metal will be gone. This is the supply shock that we have been warning about, and it is here. It is not coming next year. It is not coming next month. It is here today. Now let's zoom out for a moment and talk about what this means for the broader financial markets, because the silver squeeze is not happening in isolation. It is happening at the exact same time as a historic move in gold. Gold hit an all-time high today. I do not have the exact number in front of me, but it is somewhere north of $4,600 per ounce. That is a massive breakout. That is gold screaming that something is very, very wrong with the global financial system. And when gold and silver both rip to all-time highs simultaneously, it is not a coincidence. It is not just a commodity rally. It is a signal. It is the market voting with billions of dollars that the fiat currency system is failing. Now, here's the part that most people do not understand. When gold and silver go vertical like this, they do not just take money from stocks or compete with stocks for investor dollars. They do something much more destructive. They create a liquidity black hole. Let me explain how this works. The entire global financial system is built on a foundation of risk-free assets. At the base of the pyramid, you have U.S. Treasury bonds. These are considered the safest assets in the world. They pay a guaranteed interest rate. That interest rate is used to value everything else. If a Treasury bond pays 4% interest and a stock has to compete with that bond for investor money, then the stock has to offer a higher return to justify the risk. This is called the risk premiums. And every stock, every corporate bond, every piece of real estate is valued relative to the Treasury rate. But what happens when gold and silver, the ultimate risk-off assets, start outperforming Treasuries by a massive margin? What happens when gold is up 30% in a year and silver is up 170%, while Treasuries are losing money because yields are rising and prices are falling? It breaks the model. Investors look at that and say, wait a minute. Why am I holding Treasuries that pay me 4% and lose value when I could hold gold that pays me nothing but goes up 30%? And they sell the Treasuries, they sell the bonds, they move into hard assets. And when Treasury prices fall, yields rise. When yields rise, borrowing costs rise. When borrowing costs rise, companies cut back on spending, consumers cut back on spending, and the economy slows down. But more importantly, the valuation models for stocks break, because stocks are valued based on discounted cash flows. You take the future earnings of a company and discount them back to the present using the risk-free rate. But if the risk-free rate is rising, the present value of those future earnings falls. So even if a company is making the same amount of money, its stock price has to fall to reflect the higher discount rate. This is why gold and silver going vertical is so dangerous for the stock market. It is not just about money flowing out of stocks into metals. It is about the entire valuation framework of the stock market collapsing. And we have seen this before. We have seen this exact setup 3 times in recent history. 2000, 2007, 2019. Every single time gold and silver surged to new highs. Treasuries sold off, and within 6 months, a massive recession hit in 2000. It was the dot-com crash. In 2007, it was the housing bubble bursting. In 2019, it was the repo crisis that led directly into the COVID crash. And now in 2026, we are seeing the same signals. Gold and silver at all-time highs, treasuries under pressure, and a Federal Reserve that is completely trapped. Which brings us to the elephant in the room, Jerome Powell. As I was preparing this video, news broke that there is a criminal probe into Federal Reserve Chairman Jerome Powell. The probe is related to concerns about Federal Reserve independence and potential conflicts of interest. Now, I'm not going to speculate on the details of the investigation. I am not a lawyer, and I do not have inside information, but what I can tell you is this. The fact that the chairman of the Federal Reserve is under criminal investigation at the exact moment that the financial markets are falling apart is not a coincidence. The Fed is losing credibility. The market is losing confidence. And when the market loses confidence in the central bank, bad things happen very quickly. Let me explain the trap that Powell and the Fed are in right now. They have 2 choices, only 2. And both choices lead to disaster. Choice number 1, print money, lower interest rates, restart quantitative easing, inject liquidity into the system to prevent a deflationary collapse. This saves the stock market in the short term. It prevents a recession. It keeps the banks alive. But it destroys the currency. It causes inflation to spiral out of control, and it sends gold and silver vertical because every dollar the Fed prints makes hard assets more valuable. If they choose this path, silver does not stop at $100. It goes to $150, $200, maybe higher. Choice number 2, do not print. Hold interest rates high. Let the bad debts fail. Let the zombie companies go bankrupt. Let the housing market crash. This restores discipline to the financial system. It purges the excesses. It sets the stage for a healthy recovery. But it causes a depression. The stock market crashes, unemployment skyrockets, credit markets freeze, the banks fail. If they choose this path, silver might dip in the short term because of the deflationary panic, but it will surge even higher in the long term because the system will have lost all credibility. The dollar will be finished, and people will flee into hard assets as the only remaining store of value. So the Fed is trapped. They cannot print without destroying the currency. They cannot not print without destroying the economy. And the market knows this. The market sees that Powell is under investigation. The market sees that the Fed has lost control. And the market is voting with its feet. It is exiting the dollar. It is exiting treasuries. It is piling into gold and silver. This is the confidence crisis that we have been warning about. And it is accelerating. Now let me bring this back to the silver market specifically, because the Fed's trap has a direct impact on the price of silver. If the Fed prints, silver goes vertical because of currency debasement. If the Fed does not print, silver goes vertical because of the flight to safety in the industrial shortage. Either way, silver wins. This is why I tell people that silver is the most asymmetric trade on the planet right now. You're not betting on one outcome. You're betting on a range of outcomes that all lead to the same result, higher prices. The only scenario where silver goes down is if the Fed somehow threads the needle perfectly, prints just enough to avoid a crash, but not so much that it causes inflation, and then somehow a bunch of new silver mines come online and flood the market with supply. What are the odds of that happening? Close to 0. So the risk-reward is massively skewed in favor of the silver holder. Your downside is maybe 10 or 15% if there is a short-term panic. Your upside is 100% or more. That is an asymmetric bet. And asymmetric bets are the only bets worth taking. But here's the critical point. The window to take that bet is closing rapidly. 2 weeks ago, you could buy silver at $75. Last week, you could buy it at $80 with a small premium. Today, you are paying $85 spot, plus an $8 or $9 premium. So you are at $93 or $94 all in. Next week, you might be paying $15. The week after that, you might not be able to buy it at all because the dealers will be sold out. This is the escalator effect. The price is going up one step at a time. And every time you hesitate, every time you say, I'll wait for a pullback, the escalator moves up another step. And eventually you look up and realize you are 10 floors behind. So if you have been waiting for the perfect entry point, I have bad news for you. The perfect entry point was 2 years ago at $20. The good entry point was 6 months ago at $30. The acceptable entry point was 2 weeks ago at $75. Today at $93 to $94 all in is still a reasonable entry point if you believe the thesis, but it is not perfect, and it is getting worse every day. So you have to ask yourself, do I believe that silver is going to $150 or $200? If the answer is yes, then paying $94 today is fine. You're buying at a 50% discount to the future price. But if you hesitate, if you wait for a dip that never comes, you are going to be the person who watches silver hit $200 and thinks, I should have bought it at $94. Do not be that person. Make the decision now. Now, let's talk about the mechanics of how you should be buying silver in this environment, because the strategy that worked 6 months ago does not work anymore. 6 months ago, you could buy an ETF like SLV and feel relatively safe. The ETF tracked the price of silver. You got your exposure. You could sell whenever you wanted. It was liquid and convenient. Today, buying SLV is a gamble because SLV is backed by physical silver held in a vault by JP Morgan. And we do not know if that silver actually exists. We know that JP Morgan has a private hoard of 750 million ounces, but we do not know if they are using that hoard to back the ETF or if they are keeping it for themselves. And more importantly, we know that the SLV prospectus has a clause that allows the custodian to cash settle in the event of a market disruption. So if the COMEX breaks, if the delivery system fails, if the vaults are empty, SLV can just give you cash instead of silver. And what good is cash if silver is trading at $150 and you get paid $85. So SLV is a risk. And in an environment where the physical market is breaking, I do not recommend taking that risk. The safer option is PSLV, the Spratt Physical Silver Trust. PSLV is domiciled in Canada and it stores its silver at the Royal Canadian Mint. It allows for physical redemption if you hold a large enough position, and it has a more transparent auditing process than SLV. Is PSLV perfect? No. But it is better than SLV. The best option, of course, is physical silver in your possession. Coins, bars, rounds, stored in a safe in your home or in a private vault that you control. Yes, you will pay a premium. Yes, you will have to deal with storage and security, but you will actually own the asset. And in a world where the paper markets are failing, ownership is everything. So if you are buying silver today, buy physical. Pay the premium. Deal with the inconvenience, because the inconvenience today is going to save you from the catastrophe tomorrow. And if you cannot afford to buy physical, if the premiums are too high, then at least buy PSLV instead of SLV. Give yourself a fighting chance. But whatever you do, do not sit in cash. Do not sit in treasuries. Do not sit in a money market fund earning 4% interest while the world burns around you. Because the Shanghai price today, $93.31, is a warning. It is a signal that the paper market is dying. It is a signal that the physical market is the only market that matters. And the gap between the two is going to keep widening until the paper market finally breaks completely. Now, let me give you the timeline as I see it, because people always ask me, when is this going to happen? When is the COMEX going to break? When is silver going to $150? I do not have a crystal ball, but based on the data, based on the Shanghai premium, based on the dealer inventories, I believe we are looking at a matter of weeks. The delivery notices for January are going to be released soon. If they show a spike in demand, if they show that a large number of contracts are standing for delivery, it will trigger a panic. The market will realize that the COMEX does not have the metal to deliver. And once that realization sets in, the price will gap up violently. I am talking about a $10 or $15 gap in a single trading session. I'm talking about silver opening at $100 on a Tuesday morning because something broke over the weekend. And when that happens, the premiums on physical metal are going to explode even further. Dealers will charge $20 or $30 over spot. Mints will stop taking orders. The retail market will effectively shut down. And if you do not have your silver by that point, you're not going to get it. You'll be stuck watching the price go to $150, $200, knowing that you could have bought it at $94 if you had just acted. So the time to act is now. Not tomorrow, not next week. Now. This is your Lehman Brothers moment. But instead of a bank collapsing, it is a commodity market collapsing. And the Fed cannot save it by printing more dollars because you cannot print silver. The Shanghai price today, $93.31, is the smoking gun. It is the proof that the system is broken. It is the proof that the arbitrage is dead. It is the proof that the two markets have split into separate realities. And the Western market is living in a fantasy. The Eastern market is living in reality, and reality always wins. So get out of the fantasy. Get out of the paper market. Get out of the ETFs that might not deliver. Get out of the futures contracts that might get cash settled. Get into the real. Get into the physical. Get into the metal that you can hold in your hand. Because when this system breaks, and it is breaking right now, the people who own physical silver are going to be the winners, and the people who own paper promises are going to be the losers. The choice is yours, but the clock is ticking. The Shanghai price just hit $93. The US price is at $85. The gap is $8 and widening. How much wider does it have to get before you realize that the paper price is a lie? This is John A.G. from Currency Archive. Remember to like, subscribe, and share. Get your money out. Get your silver in.